What we'll do next 15, 20, 25 minutes with Maneesh Dangi is debate, deliberate, and discuss that what exactly are markets indicating. One side, equity markets and the way how richly priced stocks are coming down, markets are telling you that rates will go higher. Then why are global bond markets and locally we've not seen a sell-off? Growth versus inflation dynamics, where do we stand? And central banks who are confident of the word transitory about inflation, that narrative seems to be changing. Now, Manish has argued this for many months now that central bankers this time are behind the curve. He's argued that inflation is here and the only way to bring inflation down is going to increase interest rates. Manish, looks like that template which you sketched for us seems to be working out. But typically, when you see the fear of low growth and inflation coming back, bond markets they sell off. Why is that not happening?
So, morning, Nikunj. The bond market are actually the long end of the bond market. Of course, is pricing eventual growth landscape that we'll have in the world, both in US. It doesn't have much insights as far as Indian bond markets are concerned because of the fiscal dominance and active RBI intervention at this stage. But in general, bond markets are pricing a growth scare, Nikunj. It basically is telling you that while in short term, the policies will be pivoted to contain inflation, but given the debt demographics and the underlying conditions of economy, it's very likely that in 6 to 12 months time, the equities and the participants actually will begin to focus on the next narrative, and which is the narrative that bond markets are focused on right now, which is the growth scare. Now, Nikunj, for last few months, I've made this point many times with you, and that the markets and even the policymakers were somewhat underappreciating the persistence of inflation, and they will sort of change the tack, and markets won't like it, and which is what precisely is playing out right now. So there are two parts to the story. One is the change in the policy narrative, which is what is getting reflected in the short end of the bond yield. The 2-year bonds in US are up from 15-20 basis points in September to 60 basis points. So the 2-year rates have actually risen. So what are they telling us? They're telling us that we understand that Fed would tighten rates. There's something similar has played out in India also to a certain extent in last 4-5 months, if you take a little longer horizon, that the short end has actually repriced higher. But the long end, which is more of a play on how the real growth will play out over a long period of time, along with, of course, inflation, they're telling you that, look, growth is going to be underwhelming as it was pre-COVID. And they're also telling you that because of the policy tightening, fiscal drag, energy crisis, all of them will limit the space for the economies to grow. There's already data hinting at it, Nikunj. Some of them are coincidental, some of them are leading. So the rate of change framework, at least that I use, with respect to US and many countries regarding industrial production, retail sales, employment generation, all have actually peaked in the middle of the year. The dollar has bottomed, which is again a favorite indicator of mine, in June. And that's the point I've been making, that, people are again mispricing the dollar trade. Dollar will appreciate because every time Fed actually does excessive stimulus, or US does excessive stimulus in response to a crisis, US recovers very fast. But they begin to tighten faster than others, leaving emerging markets in many countries actually in limbo. So which is what is going to happen in next few months. The dollar will continue to tighten, but it's actually bottomed at 90 in June. It's 96, 97 now. The bellwether markets like Korea too topped in June. So all of them actually are telling you, along with, of course, Chinese credit impulse, which has been anyway slowing and which is a great lead indicator, but 6 to 12 months ahead of markets, that, things are, as far as growth is concerned, slowing. So in substance, to your question, that what are bond markets telling us? They're telling us that while central bankers were late, but they will end up killing whatever sort of, mild recovery that we had to the extent that in long run, for a variety of fundamental and structural reasons, we'll get back to the level of growth that we were used to before COVID, which is lowish. And that's why they're pricing the long end bond yields much lower than what many had anticipated.
Manish, what are the chances that central banks may use Omicron virus spread as a reason to make noise around growth and raise concerns around supply issues, and they keep interest rates subdued? While the template will prompt them to increase rates, but they may understand what is coming next, and they may use the current virus spread as an excuse to keep the rates subdued.
It's a great question. It's just that I think, Nikunj, that Omicron is purely one of the many health crises that we will continue to have. Hopefully, less and less lethal, but we will continue to have with respect to COVID. Its implications on markets and policy reaction function will or has already faded. The COVID's implication, it has already faded. So it's a great deal as far as health authorities and the administration is concerned. But from central banks and from markets point of view, it's a thing that at least in my model, I sort of tend to ignore it. The reaction function of central banker right now is that, look, we've delayed the response to secure some reasonable growth. But then market's reaction to that is that because you were late in responding, we know that you are now inelastic to the evolving growth dynamics. In a sense, even if growth were to slow because of Omicron or something else, Fed and many other central bankers, and more specifically emerging markets, would not have leverage to sort of react to that slowdown because they've been late to inflation. It's the first time, because again, let's accept this, at least in developed countries, of the sort of inflation they've had in last 30, 40 years, first time it has happened. And they've been pretty late. They've used all excuses, including Delta and such likes, to delay. The supply chain related constraints have led them to give a narrative to the market that it was transient. But in the end, Fed folded last week. In fact, they folded about a month ago. They started to surprise market that we understand that it's not transient. And a lot of factors in play, Nikunj, are factors which are perhaps not going to fade away anytime soon. So therefore, while I agree that Omicron could potentially be a risk to, let's say, Europe at this point, perhaps India in few months with respect to growth, but then its influence on market and policy making would be somewhat limited. I'm trying to make a subtle point here that, because policymakers have already been late, they do not have much degree of freedom to accommodate, new sort of factors of growth slowdown, because the chief risk has already materialized, which is inflation. And so, inflation is relatively a lagging indicator, Nikunj, in a sense that, once it is there, it's going to sort of sustain. Summers actually made an argument, very interesting one on a Twitter storm, that never ever any inflation has been solved by policymakers without sort of creating recession in the economy. So once inflation is already there, because it is so late, and if the policymakers are determined to solve it, they end up constraining economy to the extent that it enters in recession. While no data at this stage is actually telling us that there could be recession, but then the history sits against this narrative that India or any other country in the world which has had inflation would sustain good growth, even though central bankers are able to sort of deal with inflation. So in a sense, that asymmetry lies, and which is what markets, again, bond markets specifically, and now equity markets are beginning to sort of worry of.
Okay, so Manish, another follow-up question is that while you've painted the template beautifully for us, which is that inflation comes, dollar index goes higher, bad news for emerging markets, equities, they tend to return volatile. But the difference, Manish, some could argue, is the pure balance sheet positioning. India's forex reserve of other emerging markets, the way how manufacturing cycles are changing. China is a different beast altogether. So while the data points historically have played out the way you argued, what are the chances that this time indeed it is different?
Because or balance sheets of countries and the world at large is weakest ever. Uh, so while we focus on the balance sheets of households, let's say in US, of India's industrial empires, firms, but they are sort of part of the whole, which is the whole of the world, and sort of we all, at least in finance, look at balance sheets through the specs of debt and potential growth. So debt is, of course, at highest ever level. It is true that some of the excessive debt since GFC in most developed countries have come on the balance sheets of nations, and it's not lying in the household balance sheet. They're actually pretty clean. But the public balance sheets are extremely indebted. And one would argue, as Rogoff and Reinhardt have argued, that at this level of debt, history is not with you, that you won't have crisis. At 90% plus sort of debt to GDP for public balance sheets, you tend to have crises recurrently pretty much throughout the history. So that's one point on balance sheet, that the public balance sheets are very weak. Now, don't dismiss it that public balance sheets are weak. So how does it matter? As far as I'm concerned, you're an equity guy, you're investing in a firm. No, I mean, it's a concern to you because public balance sheets or healthy public balance sheets give you floor in case things were to go wrong, these balance sheets sort of create a good floor so that things do not deep dive or get depressive. Same thing with monetary policy. Interest rates in the developed countries are already zero. So the space for them to sort of go down further to re-stimulate economy does not exist. So to that extent, I think both from the stock and flow point of view, world balance sheet actually looks pretty stressed to me. That's one. Now, coming back to India, as of today, has current account deficit run rate of 3%. Now, remember in 2018, when we had 2.5% worth of current account deficit, how quickly currency sort of moved, and we got into a little bit of a risk-off cycle and growth slowdown, and RBI had to sort of literally tighten excessively. Same thing sort of was happening, of course, in the context of rest of the world, more specifically in US. From 2016-17, I remember rupee moved from 64 to 74 in 2018 because the setup was same. The current account deficit moved sort of higher. Fed was tightening, and dollar was appreciating versus our currency, and that led to the 2018 sort of risk-off setup that we had. So, in a sense, I mean, I agree with you that you look at reserves of this country, they look great, but then if you are going to be net borrowing from the rest of the world to the extent of $90 billion next year because 3% current account deficit, and when the Fed is actually tightening, there is not much space for you to sort of keep interest rates easy. You will have to tighten. That's the big headache, Nico, is that every time Fed gets onto the bandwagon of actually tightening, and especially in the context when US has recovered but the rest of the world has not recovered, because rest of the world, especially emerging market, could not do a lot of stimulus, they invariably have to follow the suit and actually tighten too much. So the degree of freedom, to countries like ours, is less. The monetary sovereignty is not much with us like Europe and US. So if they tighten, you will have to tighten. And to that extent, I argue that the balance sheets are weak, but even the income statement of the country, which is about growth, is actually going to weaken at margin in next couple of quarters. These are all sort of big picture traits which are going to play out over next 6-12 months. It's just that the market's job is to actually price what is not priced incrementally. And that is what determines the direction. So I'm afraid that, these dominant conversations that we've had for last 4-5 months, 3-4 months rather, were speculative in the past, but they're playing out as we speak.
Market's job is to price what has not been priced. I want to build on that further and just get straight to it, Maneesh Dangi, and that is what our viewers will want to know. Asset allocation. The last time you were here on ETNOW, you said it. Equity is the longest duration product. You were also talking about farmland that day.
Yeah, so I mean, look, Nayantara, the asset allocation, let's say first let's build on the equity piece. The for equities, central bankers directional delta matter more than the total magnitude of rate hikes that they'll do. And because as of today, most equity, look at in India also, from Paytm to Nyayaka to many other sort of new names, many names in Nifty, they all are pricing distant growth, and they're hypersensitive to interest rates. And those are the sort of long dated growth which get hurt the most. You see, what's happening in US hyper growth stocks. They sort of have corrected by 40-50% in last 1.5 months. I mean, don't talk of fangs and stuff like that, but just beneath that, these hyper growth stocks, which were actually trading at euphoric valuation, 100-200x of sales, they are sort of down dramatically. I'm afraid that something similar may continue to play out because a lot of these sort of hyper growth stocks are supported by the assumption that policies will remain near zero or very low for very long. When that begins to change, the assessment for these stocks and would begin to change. So to that extent, purely from equity point of view, I continue to, since August, I have actually cautioned. I continue to stay sort of skeptical and cautious. Also, a small angle to the whole trick to play equity was financial repression over last 6 to 12 months. I made this point with you folks, many times, that if inflation stays high, but interest rates are depressed, that's actually a great setup for what do you call it, stocks. But now that's not true. It's now inflation is high, but now rates are going to beginning to react. At least the central bank are moving the needle. QEs are stopping. India OMO and GSAPs are actually gone. All of that actually means the real rates will perhaps rise, and that's actually quite costly. So in a sense, from a policy and macro setup point of view, a lot of these things are actually negative equity, and therefore my suggestion continues to be that while for active guys, one can do buy drawdowns and sell upswing, so don't bet on directions of the market. But for the investors, my view has been for the last 3-4 months that be underweight risk assets. More specifically, now you can be underweight many ways. You can be underweight by disowning or not owning small and mid caps because they are high beta. There is a lot of illiquidity sort of built in them, and they actually are more susceptible to growth sort of drawdowns, and which is why they can hurt you a lot. Second, I think people should align their portfolio, and I made this point since July many times, that align your portfolio with big indices because they help you navigate uncertainty better, because the inherent liquidity of big indices reduces the uncertainty premium. Raise cash, more importantly. Again, the idea that the cash is trash is awful, and raise the cash actually will help you afford a lot of degrees of freedom. So Nayantara, the point is that we underweight equity and raise cash is the key narrative that I would ask investors to prepare for.
Right. Advice there coming in from Maneesh Dangi, who's been discussing macros with us. It's always a pleasure having you on the channel. Thank you so much for joining us live today. Here's wishing you happy holidays and a very happy new year. Ladies and gentlemen, we have to take a short commercial break.